couple more minutes and let people fill on in, and then we'll start here in about 2 or 3 minutes. All right, we'll go ahead and get started here. So good evening to everyone. I want to welcome you all to our Tuesday night free webinar series. My name is Nate McGee, for those of you who don't know me. I am the FOREX live trading specialist here at Microquant. And tonight's webinar, we'll be discussing really the basics of the FOREX market. Just be somewhat of a crash course here. So if at any point in time throughout the webinar you have any questions, please feel free to let me know. I'll try to answer them as soon as I can, as long as they're somewhat pertinent to the topic at hand. If they're going to take a little bit longer to discuss, I will probably try to answer those toward the end of the webinar. But we'll kind of go through here, give a quick overview. It's not going to be too in-depth, but just a nice introduction to help you out here. So that being said, we'll go ahead and get right into it. Read off a couple of disclaimers that I'm sure everyone has seen before. So trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content, or from an inability to access such information, or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. That's not really applicable too much here because we're not really showing trading stuff, just giving information. But we also have to show the CFTC Rule 4.41. This is a U.S. government required disclaimer. Basically, it's just saying that everything is hypothetical, meaning that what's happened in the past doesn't necessarily mean anything will happen the same way in the future. As you know, hindsight is always 20/20. If results were meant to be exact in the future, then everyone would probably be a profitable trader. So we'll go ahead and get right into it. If you do have any questions about these disclaimers or anything like that, feel free to contact us here at Microquant. We'll be sure to give them to you. Or if you just want some good nighttime reading, be sure to send those over to you. All right, the introduction to the Forex market. What we'll be talking about tonight really is what the Forex market is and why you would want to actually trade it. We'll introduce you to the currencies and some of the basic terminology. With it, we won't go too in depth, but at least we'll get you kick-started. We'll talk about how the Forex market works and what actually drives it. Talk about the participants in the Forex market, ways to analyze it. And then, of course, we'll talk about some of the common pitfalls that new Forex traders make, as well as give you some tips on helping yourself become a bit more successful. So the ever-burning question here is, what is Forex? Investopedia.com has a nice definition of it. There's no need to reinvent the wheel too much here. So Forex is the market in which participants are able to buy, sell, exchange, and speculate on currencies. Foreign exchange markets are made up of banks, commercial companies, central banks, investment management firms, hedge funds, and retail Forex brokers and investors. The Forex market is considered to be the largest financial market in the world. Because the currency markets are large and liquid, they are believed to be the most efficient financial markets. It is important to realize that the foreign exchange market is not a single exchange, but is constructed of a global network of computers that connects participants from all parts of the world. So pretty simple. I will, however, go ahead and break it down a little bit because it can be a wee bit wordy here. So Forex is an acronym for foreign exchange. Other common names are FX or the currency market. You'll see these all being used interchangeably. In short, it is the exchange of world currencies. That kind of really shortens the definition that they gave us. It is a global decentralized market for the trading of international currencies. That means it's not centralized. Don't have to go through any exchange like you would, say, in the New York Stock Exchange. It's really over the counter and no one really controls it or anything like that. Profits in this market are made on small changes in the exchange rate, and we'll explain what that is a little further on. Currencies are traded against one another in pairs. So that's a really important concept to understand about the Forex market. And when it comes to that note about it being the largest market in the world, here's a little bit of a breakdown of the figures here. The daily turnover is about 3.98 trillion. You can see how it kind of breaks out here. 1.49 trillion in spot transactions, 475 billion outright forwards, and the other bigger numbers there, as you can see. This really does trump many other, well, most of the other exchanges rather, by tenfold and 20-fold, and even combining them, such as the futures market only has right around 400 billion in daily turnover. You can combine the futures and the New York Stock Exchange and many others, and it still won't be anywhere near the size of the Forex market. So it is quite big. So why would someone want to trade Forex? Well, there's a few reasons. I'm not going to list them all here, but high liquidity. It's very easy to buy and sell in this market. You don't have to have an issue with getting an order filled too much. With technology, this is pretty streamlined, so you don't have to worry about that. It is a 24-hour market. The Forex market is open 24/5 from 5 p.m. Eastern Standard Time on Sunday until 4 p.m. Eastern Standard Time on Friday. So when it opens up, it's really opening up out in Sydney, and then the opening starts moving westward in Tokyo, then to London, and then it opens up over in New York, And then at the time that the New York session closes, that's when Sydney opens back up, and that's what keeps it staying open for the whole 24 hours. There are no commissions. All traders really have to pay here is a bid-ask spread, which is very minimal, especially in the really liquid currency pairs. Leverage. This is one of the biggest tools in the Forex trader's toolkit. A small deposit can really go a long way. So in the US, you can get up to 50 to 1 leverage. In other words, you deposit $500, it will allow you to trade upwards to 25,000. So that's pretty amazing. We'll talk about some of the risk associated with leverage though a little bit later. Also, knowing the corner of the market. The Forex market is way too large to be controlled by any one person. Not even Chuck Norris himself can beat this market. It's that big. You don't have to worry about any one person taking over, like Google taking over the world or Apple taking over the world. This is pretty controlling itself. It's a relatively easy startup. Don't have many upfront costs like you do in futures in any other market. Like futures typically have a really large initial deposit, somewhere between $2,000, $2,500 and up, whereas in the Forex market you can start with as little as $1, but not really sure why anyone would do that. The free information. There is plenty of information out there for the Forex market. Plenty of brokers offer demo accounts so you can trade simulated in the real-time market conditions, not have to risk your money yet. You can see how it all works so you can get a better feel of it. Plus there's many resources out there that give information about currency pairs. You don't have to track too much per se because there's only a limited amount of currencies as opposed to thousands and thousands of businesses in the stock market. So there's a few of the reasons there. We'll go ahead and introduce you to some of these currencies, what they're all about. So the primary currencies are as follows. We have the symbols on the left. These are the 3-character ISO codes given to the currencies. And you can see their associated countries. So the USD is for the United States, and that is the dollar. Common nicknames, these are something that you want to become familiar with if you're going to be participating in this market. The buck and the greenback for the dollar. The euro, that is the EUR. Nickname for that is a fiber, or a lot of times it's simply just called the euro. The JPY is for Japan, that is the yen. Most of the time people just reference it as the yen. GBP is for the Great Britain pound. Cable and the sterling are some common nicknames you want to know about that. CHF is the Swiss franc, and common name for that is a Swissy. And then on down this list here, we have the CAD for the Canadian dollar. It's commonly referred to as the loonie, or sometimes just the CAD. The AUD is for Australia. That's called the Aussie. Pretty nice. And the NZD is for New Zealand, and that is typically called the Kiwi dollar. Now this list right here, this is going to help us kind of understand how currencies are paired up. Whenever we see currency pairs, or when we trade the Forex market, everything is paired together, so it's always one currency that's paired with another currency, and that's how you trade it as a single unit. So this list right here is the order of the pairing. It doesn't really mean the strength of it or who's number one here. It's just how it's set up for the Forex market. And the higher up that you are on the list, that's where the base currency is, and the lower down you are is the counter currency. So when we pair things up, if I bring up the pen here, so that's how we get pairs like the GBP USD. This is lower on the list on this. So this is going to be the base currency. This is going to be the counter currency. But then whenever we have things like, remove this, but when you have currency pairs like the US dollar yen, you can see why the US dollar is a base and the yen is a counter currency because it's lower down on the priority list based off this structure. So you never will have the yen ever be a base currency because it is the lowest on the list. So the major currency pairs, these are the biggest and most commonly traded currency pairs in the Forex market. About 85 to 95%, it varies on what stats that you look at, but about 85 to 95% of all transactions in the Forex market happen in these 7 pairs. The reason why these are called the major pairs is because they are paired with the US dollar. All right, so that's something you want to keep in mind. Now, don't get faked out here, because you will see other currency pairs with the US dollar, such as exotic pairs. You'll see like the USD ZAR, which is the dollar South African rand. That's not considered a major pair because it's an exotic. We're talking major pairs are these currencies right here that are paired up with the US dollar. So the FX nickname for those, you'll hear people say the euro dollar, the pound dollar. That's kind of how you'll hear things referenced. So when you say I'm long the dollar yen, you'll kind of understand what they're actually meaning. It's the US dollar versus the Japanese yen, or the US dollar versus the Swiss franc, and that sort of thing. Now you also have many other currency pairs besides just these, obviously. Pairs that aren't paired up with the US dollar are called cross-currency pairs. The logic behind the sequence, I'm not really sure about it. It's just something that kind of came about. It's interesting to say the least, but it's kind of just been there since the Forex market has been regulated. It's something that they established in the past. I couldn't even really tell you behind it. It's just more of some of the standards set up by the ISO and then the financial markets back then. So and you would think the US dollar would be top of the list, but hey, it's been working so far, so I'm happy with it. So these cross-currency pairs, anything like we said that's not paired with the US dollar. The Euro GBP, this is the Euro pound, the Euro CHF, the Euro Swissy, Euro versus Swiss franc, and you can see again the same logic applies to crosses as they do with majors. So the GBP AUD, we'll go back to our list right quick. You can see the GBP odd. You'll never see the odd GBP. So hopefully that makes sense to everyone. We won't really touch too much on the exotics. They are there. We'll save that for another webinar here in the future. So this is just going to be a quick crash course to get your feet wet and get you maybe interested. So you're going to need to know a little bit of Forex terminology. I try my best here to bring it down to the bare minimum, the stuff that you really need. You might get overwhelmed if you're trying to Google Forex and try to figure out which terms you really need to know. I know it was kind of frustrating when I first started out in the past trying to figure out what things were, and I was looking at MACD and not knowing what MACD was. And really all I needed to know what a pip was. So, top of the list, you'll hear this done around this, the buzzword is pips. So what is a pip? A pip is an acronym that stands for price interest point or percentage endpoint. It is the smallest price change that any given currency can make. For any currency pairs that do not include the Japanese yen, this is something that you need to pay attention to. A standard price quote is quoted out to 4 decimal places, and that 4th number is the pip. So the pip is that number that has 4 places to the right of the decimal. And then for all currency pairs that do include the Japanese yen, the yen price quote is quoted out to 2 decimal places, and the pip is that number that has 2 places to the right of the decimal place. Now, it's not necessarily used as much, but pipette, it's not referenced as much, but it is used quite often. The pipette, many brokers have extended their regular quotes out from 4 and 2 out to 5 and 3 respectively. So sometimes you'll hear this pipette be referenced as a fractional pip or a point or half pip. It's just really to help give you a better entry point and a better feel of what the market's doing. It gives you a little more accurate pricing. The only real thing you need to take away from this is that for the standard currency pairs that are not paired up with the Japanese yen, the standard price quote is quoted out to 5 decimal places instead of 4, and that pipette is the number that is the 5th place out. And then the same thing on the Japanese yen pairs. The yen price quote is quoted out 3 decimal places, and the pipette is a number that is 3 places to the right of the decimal. So we'll kind of break it down for you to see what we're talking about. I have this spiffy looking drawing here that I made in paint. The euro US dollar quoted at 1.33461. We'll go ahead and break this apart for you so you can see what's going on here. In this price, the 1.33461, 1 is a dollar, 33 is the cents. That's what we're used to. Now that we're getting into Forex, that 46 is the percentage of a cent. So in order to get 1 cent, you're going to need to have 100% of something. So it can also be said to be 46% of a cent or 46/100th of a cent. And that number 6 up there, that's your pip. And then take it one step further. That 1 is 1/10 of a percent. To make it a little more confusing for you, but that 1, that is your pipette. We'll see how it looks right here. Another fancy drawing for the yen. For the US dollar yen here, the 97.95.9. Breaking this price down, you'll see 97 is the yen. 95 is the percentage of a yen. And we can say right here that this is 95% of a yen or 95/100th yen. The pip is that 5. And that 9, again, is 1/10 of a percent. And that 9, that's your pipette. So does that make sense to everyone? If we're good, we're good. The reason why the yen is quoted out there to 2 decimal places, I just always went with it before, saying, okay, that's fine. But there is a reason behind it. I'll go ahead and explain that briefly here. The yen is the lowest part of the Japanese economy's currency. So in the US economy, we have dollars, but then to break it down a little lower, we do have our quarters, our nickels, our dimes, and our cents. So we can't break it down much further. Likewise, the euro has a euro cent, the pound has a pence, the franc has a rappen, but the yen has nothing. That's the reason why. There is no yen and a half, a yen quarter, or anything like that. The yen is the yen, that's the yen. So the 97 is a yen, basically a dollar in a sense, and then we're still taking the concept of a percentage like we do for our cents, and we're applying it to that, and then we're throwing out a pipette as well. That's the reason why yen pairs have only 2 or 3 decimal places. So let's talk about base and counter currency. This is an important concept to understand when you're in this market as well. So the base currency is the first currency in the pair that is located to the left side of the slash. The base currency is where we're performing the base action. So whether we buy or sell, that's going on based off the EUR in this case, the euro dollar. In other words, this is the basis for the buy or the sell. And it's worth noting that the base is always 1. So if that was a GBP, that would be 1 pound. If that was the EUR right here, that would be 1 euro, and so on. Now the counter currency is also known as a quote currency. It is the second currency in the pair that is located on the right side of the slash. And the counter currency is what the exchange rate is quoted in. So the rate represents how many units of the quote currency are needed to buy 1 unit of the base. So in our example here, it will take 1.3 0.33461 units of the US dollar to purchase 1 euro. That is how it kind of works here. Does that make sense to everyone as well? Don't want to get confused on this. This is kind of the important part to understand when you're trading this market. But this whole thing right here is still considered to be a single unit. You're basically trading them as a single unit. So, okay, I'll break it down a little bit more. So, currencies are paired together and you trade them relative to each other. So if you're going to buy this currency right now, you are buying the euro, the base, and you are simultaneously selling the US dollar. What you're trying to get out of this is that you're expecting the euro dollar to strengthen relative to the US dollar weakening. So as it goes down, you're making profits because the euro dollar is going up. Likewise, if you want to sell the euro dollar, this currency pair itself, you are selling the euro and simultaneously buying the US dollar. So it's still that one unit of currency, but that's how you're expecting it to move. It moves as one, and you're using the quote over here as your guide. So this is what the quote is in the dollar. This is always going to be 1. Does that make sense? Does that clear anything up? All right, cool beans. Let's go ahead and head on over here to the lot. A lot, this is the position size of the currency being traded that's equivalent to a certain dollar amount. Okay. Whenever you place a trade, you trade in currency blocks or lots. Sometimes, like in other markets, you'll have contract sizes. But unlike the other markets that have fixed contract sizes of being, 8,000 gallons of oil or whatever it is out there in the futures market, you can adjust these accordingly. And they usually go in powers of 10. So most brokers offer 4 categories of lot sizes here. A standard lot is 100,000 units of a certain dollar amount. So just, for example, $100,000 worth of currency control. Then you have a mini lot, which goes down to power 10 to 10,000 units, and then a micro and a nano. And these kind of go into play whenever you're trading. It helps you with your gains and also with your leverage and things like that. So that being said, we need to understand a little bit about the pips here. So a standard lot is 100,000. The value of the pip on that, so every time a pip moves in the market up or down, you're getting $10 for it. So in other words, if you were to buy the euro dollar at 1.24678, okay, and the euro rose, actually, it rose from 1 2 4 7 3 4. How many pips did we get? 6. Okay, so it went up 6 pips from here. And then if we're trading a $100,000 lot, each pip is $10. So 6 times 10, that's $60 that you made. Likewise, if you look at these other lots, so if you're doing a micro lot, only trading 1,000 units, and you can see you made 60 cents. So fantastic for you. This is why whenever I was saying, I'm not sure why brokers would offer a minimum deposit of $1 to people, because doing a 50 to 1 leverage, they can only trade up to about $50, and they're not really going to make too much money in the forex market. Leverage is really what helps you out to make money here. We'll talk about leverage here right now. So leverage is the ability to control large dollar amounts with a smaller amount of capital. Because the market moves in such small amounts, we need to be able to magnify our trade sizes in order to earn a decent profit. If the exchange rate did go up 1 cent every time, then we would be making bank and probably really not have a need for the Forex market. But since it does not, that's where all these pips and pipettes come into place. So leverage is, in a sense, it's the amount of money a trader can borrow in order to hold a position, although there will never be an exchange of money between hands. The broker is still considered to be lending you the additional capital. It's not like I can go to the broker, put in a trade, he gives me $85,000 and I can just go ahead and walk away. It's never changed any hands at all. Leverage amounts range anywhere between 10 to 1 all the way up to 400 to 1 in different countries. For the US though, we are limited to 50 to 1 leverage. And leverage really does benefit the trader in the fact that it doesn't mean we have to put up the full value of the trade. It makes sense because not many people have over 100,000 to trade right from the start, but with 50 to 1 leverage here, all you're required to really have in your trading account is $2,000 and you can still be able to trade with $100,000. In the simplest of terms, for every $1, you can trade $50 worth of a position with 50 to 1 leverage. Does that make sense to everyone as well? So we'll go ahead and carry on. Awesome. Margin, the next thing you need to understand. This is the amount of money in an account to open or maintain a position. This is your security deposit. Basically, when you are trading the Forex market, it is held in good faith by the broker. Try to give a real life example for this. Basically, it's, say you're going to move into an apartment and you're going to need to put a security deposit down. So we both agree to sign a contract, whatever. And as long as you pay rent and you take care of your room and all that kind of stuff, the security deposit is just there for when you leave, you get it back, right? If all goes well, you'll give it back. But if you don't pay the rent or if you leave things broken, then you probably won't get back the $1,000 deposit or whatever it is. That same concept here with margin. If you have $2,000 in your account, they'll take out a portion of that in hopes that you'll take care of your trade and it won't go against you. And margin really does help you out here. I'll try to explain that a little bit better here in just a second. But amounts vary right here, as you can see, anywhere between 0.25% and 5% of a total account balance. So here's a few different numbers here. With 400 to 1 leverage, the margin requires only 0.25%. If you're trading one standard lot here, they're only going to be pulling out about $250 of your total account equity. But if you're US, you're really looking at the 50 to 1 here. With to take out 2% margin for trading a standard lot here, then the required margin is $2,000. So this is why I wouldn't recommend necessarily trading with the smallest amount possible. Try to give yourself a little bit of money. So with these margin accounts, I figured this would probably come up. It's it helps you out a little bit in a sense, because if you have a certain amount of equity here in your account, and whenever you're putting a trade in, that margin there is to really help you in case a trade goes against you. Let's see the best way to explain this. So say we have about 50 grand or whatever it is in the account, and we're putting a trade out there. We're taking a, I don't know, a $500,000 contract. If we're taking out margin here and say the margin, for example, is just 3,000. Okay. If the positions go against us too much, which if you're putting a stop loss in place, you should be fine. But if you're forget to put a stop loss in, or you set your stop loss 40,000 pips or $40,000 away from your total account equity here, and then it does actually get stopped out, then you're not really being smart about it. But say, for example, it does go against you really bad, you forget to put a stop in, and you're about to blow up your account. If the amount of margin that you have, there's types of margin here. You have used margin and usable margin. If the usable margin runs out of your account, then you will get margin called by your broker. They'll close out your positions and basically get you out of the market, and you're left with your margin. So you won't necessarily go down to zero, but if you do lose $45,000 or whatever it is, you're hurting, but at least you walk away with that $2,000 margin or whatever it is. So it is really there to help you out. It's a little bit interesting, I guess, to understand. That's where people can get in trouble here whenever they are over leveraging themselves and trading multiple currencies and not understanding what margin is, what's actually being held, because margin is actually money that is in your account, and whenever you do place a trade, the broker will take the margin and separate it from your account balance during the trade. But as soon as you close a trade, whether you win or lose, you'll get it back for the most part. What I say by the most part is just as long as you're not getting margin called. And you shouldn't if you're trading properly. Generally, you'll always get your margin back. That makes sense. Basically, the concept is you're using margin to trade on leverage. All right. Here we go. Bid and ask. These are two key phrases here. The bid is the price that the market or the broker is willing to pay to buy the currency pair from you. In other words, this is what you can sell the currency pair at, and you are selling that base currency that we were talking about. Then, of course, you have the ask here. The ask is the price that the market or the broker is willing to sell the currency pair to you. And in other words, you can say it's what you can buy the base currency at. If anyone's selling to you, you're always going to buy, right? So you're buying the base currency. And it is worth noting that the bid will always be lower than the ask. The reason they do this is because they want to discourage selling. So they want to give you a cheaper rate for that. But the rates aren't really that bad. I mean, you're only looking at like a 1 or 2 pip spread, so no big deal. A few other terms you need to know. The spread, that's the difference of the price between the sell quote and the buy quote. This is also known as a bid-ask spread, and this is where your broker will charge you for the spread every time you place a trade, and that's really how they make their money. Slippage is something you have to deal with a little bit here occasionally, like especially during news announcements. It's what happens in price between the time you place an order and the time your order is filled that may cause your order to be filled at a price that is actually different than what you actually originally planned to get it filled for. And this really only happens with major news announcement, and there's a lot of volatility. Don't have to worry about it too much. Long, that's when you're buying a currency pair. Saying is that you're going long the euro dollar. Short, that's when you're selling the currency pair. Saying is you're going short. So that's basically the very minimum forex terms that you need to know for this market. If you want to start getting a technical analysis and all that, that's a whole other ballgame. And we have those coming up in different webinars. But this is what you need to start out. So how does the forex market work here? Okay. The forex trades involve the simultaneous buying of one currency and the selling of another currency. However, this currency pair itself is thought of as a single unit. So whenever you're buying, you buy or go long the currency pair. You're buying the base currency, so the euro, and you're paying the ask price. So same thing with selling. When you sell, you go short a currency pair. You are selling the base currency at the bid price and receiving that quote currency. So if you are selling that euro US dollar, selling that euro, and you're actually purchasing at the same time US dollars. That's the shortened version of it. Here's what a sample forex quotes look like. You can get these in your broker. You can get these on websites as well. They're all over the place. But you can see they have the bid ask price up in here, and like we were saying before, that bid is always going to be lower than this ask because they want to discourage that selling of it. But you can see there's many other currency pairs. Here's one of those exotic pairs that we're talking about. They're not major pairs, but the exotic pairs are basically emerging economies, but we'll touch on those in a different webinar. Here's what a typical Forex quote looks like. You have your quote currency and your base currency right in here. They don't always have the slash separating them, so don't get freaked out about that. They're still paired up, and you'll see the different quotes here, and they're usually, the pip part of it is usually articulated or bolded or somehow standing out here. And then you do have your little pip at value over here. But this is really what you look at, the bigger one, the 28, 29. You see right here we have a 1 pip spread, so 28 and 29. That's that bid-ask spread that we're talking about. 1 pip spread, or if you want to go out to the pipette, just 1 and 9. Subtract 9 from 1 over here, you're left with 8, so you have a 1.8 pip spread. If that's how you want to do it. I typically don't even really look at this pipette portion here. I usually just count my pips from here, and that's how I plan my stops and give myself room and plan my entry points. But it does give you a bit more of an accurate entry point. So going long or going short. When you're going long, you go long because you are expecting the base currency to strengthen relative to that quote currency. So if you're long the Euro USD with the bid-ask quote right here of 12946 and 12948, you're going long based off that 12948. That's where you're buying it at. If the euro gets stronger, then the US dollar is getting weaker. Likewise, if the euro gets weaker, then the US dollar is getting stronger. That's what's going on with this currency pair here. So if we are long the euro and the rises to 12968, we moved up 20 pips. So we moved up 20 points or pips from this 48 to 68, made a good profit. If the euro falls down to 12933, that trade went against us in a bad way. It moved down 15 pips, the difference between this when we purchased and this, and we have a bad trade. And if you're trading a standard lot here of 100,000, then this 20 pip move to the upside, 20 times 10, you got your 200 bucks, and then you made out. Again, though, if you lost 15 pips, then you're out 150 bucks. Going short, same thing, you're expecting the base currency to weaken relative to this quote currency. So we'll use the same quote here, short the Euro USD. This time we're looking at this 12946 price. And if the euro rises up to 12966 this time, then it moved up against us 20 pips, made a bad trade. Did not head down any further. But if it does fall to 12931, then it moved down 15 pips, and we're in the money for that. You need to always be aware of the bid-ask spread in the Forex market. We use that same quote. The spread is the way that the broker makes the money. You can see the spread is calculated by finding this difference in the bid and ask price. So bid minus ask equals spread. In this case, the 12946 minus 12948 is equal to 2. So we have a 2 pip spread on that. And the spread has to always be covered before you can make a profit. So as soon as you put that trade out there, you're automatically at a loss. So you want to make sure you're doing decent trades here to at least cover your spread, and you anticipate for the trade to go up to a certain value so you get a nice risk-reward ratio. So if we do go long in the Euro US dollar at the 12948 and we sell at 12950, we actually have made nothing. The only time we'll actually make profits out of this trade would be when price hits the 12951 and above. So once it hits that 12951 and above, if we were trading $100,000, we just made our first $10 on that one tick. That moved up that 1 pip. All right, that's that. Now, what actually drives the Forex market? Correct. But if you have that stop loss in place, Jim, so if you're, say you put that trade in and then you bring it down 20 pips or whatever, you're risking $80 or whatever. You know, if you have an original account balance of 10,000, not really risking too much. You're only risking $80. That margin is just there to help you in case you forget to put a stop in, and instead of losing the $80 from a stop that you should have put in, and it goes against you all the way down $8,000, then that margin call, they'll call you, and at least you get out of your trade with $2,000 to spare. So you may have blown up your account, but at least you can walk home with that $2,000, and they margin call you. So you are using that money in your account. This is where that leverage is a double-edged sword. You'll hear that being referred to quite often in any type of Forex education. It can really maximize your profits, but it can also really maximize your losses if you don't know how to use it properly. So what drives this Forex market? Rates are determined by a multitude of things here. Economic factors are one of them. They describe by and through economic reports. Central banks and government agencies changing economic policy. These are things like your GDP reports, retail sales, interest rates, employment figures, that sort of thing. Political conditions are also big factors in the Forex market. Elections, political events, and things of that nature. Anytime there are speeches by presidents, prime ministers, or if there's war, or if there's pre-election stuff, if there's new leaders about to be elected, people really pay attention to those because new leaders mean new ideologies, which means new thoughts on monetary policy and things of that nature. Plus, market psychology is another one. This is a psychology of the trader. Everyone goes through the emotions of greed and fear, and those really play a factor in it. And if everyone sees a certain price, or if everyone believes price is going to rise higher, a lot of times it becomes a self-fulfilling prophecy because a lot of people hop on the bandwagon and they can cause prices to move in that direction. Natural disasters are also a big factor. Anything that can really destroy an economy are things like this. What if a tornado or a tsunami destroyed a major manufacturing plant in Japan and they can't produce Sony parts anymore? That sort of thing. You have to factor in the cost to rebuild. So it could really weaken an economy and cause the currency to go down, the exchange rate. So who trades the Forex market? There's a lot of people that really trade in this market. We'll go over a few of them here. Super banks. These are known collectively as the interbank market. Some of the super banks you might have heard of are Citigroup, Deutsche Bank, Barclays Capital, JP Morgan, Goldman Sachs, that sort of thing. These banks participate in it quite often, a lot of times to fulfill orders for their clients, especially international ones. So these are big market participants here. Large companies, especially those that actually do a lot of international purchasing, parts and things of that nature, do imports and exports. And there's a lot of stuff going on whenever there's a merger or acquisition between two large companies. Imagine setting a price at whatever it is, and they're going to do a merger or acquisition for a couple $2 billion. Imagine what a pip value is then. If it goes down 1 pip, you could be looking at losing, $100,000 here, $40,000 there. So it can get really big. They try to use that to their advantage, though. Governments and central banks are in the markets somewhat. Central banks, they adjust interest rates in order to control a country's inflation. They don't want their currency to become too weak, but don't want to become too strong either. So a lot of times they'll be out there adjusting interest rates like the Fed does. They do quantitative easing or things of that nature, or if inflation gets too high, they set interest rates at a different level in order to bring it down or bring it up. So they do intervene a lot, especially in the Japanese government. They are known to really control their currency because it's one of the biggest exporters. So it gets really strong. What they do is they try to weaken it at all costs. Investment managers and hedge funds, these people definitely trade currencies, especially for large international portfolios, and they hedge their money so that way if one currency goes down, another currency goes up, they won't lose really anything, especially if there's instability in one country. Like in America, if there's instability, they can hedge themselves in multiple countries and not lose the value of their actual fund. Then you have speculators. This is just me and you. We're known as the retail traders, and we trade about 90% of the volume, really. We just do this stuff for short-term sort of thing. Now, in order to understand this market, you need to be able to understand the different types of analysis to hopefully benefit you out. There's really only 3 types of analysis. You have your technical analysis. This analysis is a study of price movement. You look at price movements in the past and then try to determine where price is going to move to. And a technical analysis, they use charts to visualize historical price data in order to determine where they want to enter or exit trades. And it usually involves a bunch of indicators, support resistance lines, things like Fibonacci, moving averages, and that sort of thing. And the thing about technical analysis, though, is if there's a lot of traders that see the same picture based off their analysis and believe price will go in a certain direction, a lot of times the signals or patterns really do become these self-fulfilling prophecies. If everyone sees a major trend line, everyone sees it start to break through, hop on the bandwagon, sell, and you really see it start moving in a certain direction. This is what a typical technical analysis workstation will look like. This is mine. Sometimes you'll see thousands of indicators. It seems like it's just a smorgasbord of lines and graphs, but you can see here's some support and resistance. Price is ranging, so I know that I'm not really sure if I want to buy or sell. I want to trade the breakout. That's how we kind of determine things. For fundamental analysis, these analysis studies the political, economic, and social forces that affect the supply and demand of a country. These traders really do rely heavily on current events to aid making their trade decisions. They're not too concerned about support or resistance. They really have to understand how unemployment rates, interest rates, things like that. They look at consumer price index, consumer confidence reports, and all these major reports to understand longer term where an economy of a country is heading. They have to know what it could do and what it could not do, so that way that's how they base their trades off it. Interest rates are probably one of the biggest factors. Higher interest rates make the US dollar denominated assets way more attractive, whereas the lower interest rates make them less attractive. That's why the Japanese government always makes their currency as weak as possible, because if it does have a high interest rate, it really messes up their economy. So they don't want people to pump all the money in their economy. They want to keep it as weak as possible. And this type of analysis tends to be a little slower, and traders really do hold on to positions for longer periods of time. We're talking months, potentially years. You can see there's a lot of reports that do come out for all the different countries. There's no shortage of them, so you don't have to worry about that. But this is what they look at. They see these numbers here, and they see the priorities of them. They know which ones really move an economy one way or the other. And when they see this, they'll combine it with past reports and potential outlooks on future reports and base their trades off that. Then you have sentiment analysis. This is the analysis of that site was Daily FX. You can Google FOREX economic calendar and you can get a few different sites, but Daily FX is pretty good. They also have sentiment analysis stuff up there as well. I'm actually pulling it up for you guys to see what that is. But this analysis type is the opinion of a large group as a whole. This analysis is really, what do you think the bandwagon is going to be doing in a sense? You analyze things like the tweets, text, articles, blogs, news, that sort of thing of individuals in order to kind of determine the direction of the market. If you see a major Forex analyst say, I'm bearish on this, other people will say, I'm bearish too. And you kind of get a feel of what everyone is doing. A lot of times, like it says right here, this information is published by brokers or other financial leaders that may poll analysts and get their sentiments toward a certain currency. In this type of analysis, I'll show you an example right here. You can get this sort of thing. This is from the Committees of Trades reports that's put out by the CFTC. This is for the futures market. There's no central market for the Forex, so we can't really monitor volume of it in contracts sold or things like that. But in the futures market that trade currencies, you can get this report that's delayed. It's a week old when it comes out. It's always the previous week, but you can get an idea by looking at the past of where it's kind of headed. So for example, you can see right here for the British pound sterling, the GBP, you can see how many people are long on it, how many people are short on it. Non-commercial ones like retail traders, and then the ones that are commercial traders, and you can see the ratio of it, that sort of thing. And you kind of get a little bit of sentiment from this to kind of see where a lot of the market might be predicting it's going to go. There's no real preferred way of analysis. A lot of people do use technical analysis. That's what I primarily do. But you can combine them obviously with fundamentals or sentiment and really benefit when you trade the market. So some common problems that the Forex traders make. Was I all clear on the analysis types before we go on? All right, cool. Common problems that the Forex traders make. First of all, unrealistic expectations. Many traders, they hear these Forex people out there have these products that they sell. Yeah, I could probably do that, Naga. I'll probably say that for a couple more in-depth webinars we have coming up as well. But I'll touch on that briefly probably toward the end of this. I'll show you some of the things that I do. One of these problems though that the Forex traders do make, you hear these things like, I guarantee you can make 300 pips in 5 days or whatever, these crazy outlandish stuff, and people all jump on the bandwagon thinking this is the get rich scheme. It must work. They buy that system that's guaranteed to make you $400,000 in 2 years. That's not common sense. Trading really does take hard work and dedication. It doesn't happen overnight, and it is true that not everyone can actually be a trader. Some people don't have the emotional capacity for it. Some people, it's just not their thing. Another thing is not choosing the best broker. Okay, seems like a weird one, but there are some brokers that follow the dealing desk model when it comes to trading, and others that do the straight through processing modeling. The main difference between these two is that in the dealing desk, the broker trades in the opposite direction of new traders. So whenever you put a buy order in, they put a sell order in, and every time you lose money, they make that money. And then when they're a market maker and they have massive amounts of money, it's pretty easy to push a market in one direction if they want to. So there's really a conflict of interest going on with these type of brokers, but they're still there. You want to have a broker that does yes. TS is straight through. The thing I found is that some of these brokers that have these low, like really low deposits, when you open up an account like a mini account or something like that, you are stuck with being a dealing desk. But if you put in a deposit of like 2,000, then you go to a non-dealing desk or straight through processing. It's, I guess, like a catch. So you don't want to do the smaller accounts, because in the broker they make the money on the spread. Okay, and they want you to put more money in and use more leverage, because the more leverage that you use, the more money they make on the spread. So if you're using a $100 lot, the spread between, 2 pips between a spread, you're looking at they made 2 cents to put that trade in. But if you're trading 100,000, and then the 2 pip spread is $20 for them, or if you're trading 500,000, you can see that's where they really make the money between that spread. So they want to over leverage it, make the money. So solution to this problem here is to do proper research before you choose a broker. Most new traders do not take the time. They'll Google Forex brokers, pick that first one they see, and then not realize what's going on, because they still have this greed clouding their judgment of, I'm going to make $1,000 from home every 5 minutes, and these other absurd claims. Next, over leveraging. That's a big problem. The Forex market, you trade with leverage, but if a broker allows you up 50 to 1, you can hold these positions that are exorbitant, but if you don't know what you're doing, you can really easily blow up your account. And whenever you get that greed again in your eyes and you're seeing, oh my goodness, I'm actually trading with $100,000, you're not really thinking rationally. You start using your emotions and you get into bad trades and really blow up your account. Most new traders here, they say they blow up an account within 1 to 3 months. So what you want to do here is really develop a plan and realize that you shouldn't over leverage yourself. Say a good leverage amount is anywhere between 10 to 1. You don't really want to go above there. Some of the most successful traders really only do about 8 to 1 leverage because they'll know how to get in and get out of trades. They know how to keep tight stop losses. They don't have that greed of, oh my goodness, I have $100,000. Let me make the most out of it. Then that one trade could wipe out a massive amount of gains. So you need to understand your taste for risk and stick to your trading plan and set an allowable amount of what you're willing to lose a day or a week or a month or whatever it is and meet it, and trade a simulated account. There's many accounts. Well, most brokers offer a demo account. You can still trade with a $100,000 account, all demo money, not real money, in real live market conditions, and try it out. See how you're doing. If you understand it, maybe put a deposit in. Trading without a plan, that's a big one. Trading without a plan really leads to a disaster when there's no strategy for entering trades or exiting the trades, finding profit targets and things of that nature. You're never going to know when it's right to get in, never going to know when it's right to get out, and not having those type of plans is one of the biggest faults because they're like, I don't need to put a stop loss in because I know it's going to rise up here. And then they'll lower their stop when it's going down, lower their stop, and get stopped out at a huge loss because their emotions are involved and their ego is involved. So you need to develop a plan to help you keep your head on straight, especially in heat of the moment instances. Being successful in the Forex market is all about some of your actions, not just making that home run. You're not trying to bat a home run and then retire from the Forex market and win trade. It's all about hitting them singles, hitting them doubles, and that's how you stay successful. So you need some tips here. Would be kind of bad to end this off just saying how bad it is. So tips on how to be successful. Do not open an account with a minimum deposit. The reason being is if you're opening an account with $1,000 or a minimum of $50, you can get really tied up with that. You can be really emotional with that. That's my $50. I don't want to lose $50. And then you can think irrationally. You want to set a certain amount of what you're going to trade. That way you'll understand that if you do lose money, it's all part of being in the business. And Forex trading is a business. You will have losses. Just like any business owner that does have an inventory, maybe they might have got a bad product and they don't sell it, so they're going to make a loss, but overall they're still going to make a profit. Same concept here with the Forex market. Do not buy or rely on outlandish promises others may claim without researching it first. Really, you want to become independent yourself in the market. You can look at some of these other traders and get their analysis, but that doesn't mean that it's going to necessarily work for you. Just because I trade candlestick reversals doesn't mean that's going to click with you. You can still learn, but you still want to be able to develop yourself and not necessarily follow in the band of this robot is going to guarantee you X amount of dollars. You don't know what it is. You don't know how bad the drawdown is. You don't know if it's going to work because, like those disclaimers say, past performance is not necessarily indicative of future results. You want to understand what the market is doing yourself as opposed to putting it into the hands of someone who made a robot that works for them. Learn how to use your stop losses. Always know when to put a stop loss in. Always do put a stop loss in and know how far away it should be. That's really important to know based off your certain time frames that you're in on. Develop your trading plan. That'll keep being mentioned time and time again. That next webinar that we have set up for this, intro to Forex course that we're going to be doing over the next few weeks will be actually developing a trading plan. I feel like it's the most important one first before you start getting into some of the more detailed things in the Forex market, because if you don't have a plan, you're pretty much going to fail in the beginning. It is really important. So know yourself, your risk tolerance, and your needs. You need to plan your goals and stick with them. Don't go away from your trading plan. It seems easier said than done, but it actually is quite difficult to develop and follow the plan. Many traders really have a struggle with that. Even I have a struggle with that. You need to choose your correct account type relative to your trading needs. You don't want to trade too much on there. You want to use the right amount of capital. All capital should be risk capital that you are willing to lose, and not stuff that's going to be paying the electricity or feed your kids, because if your emotions get in, you'll be tied up too much with that money. Say, I gotta win this trade or my family starves, and then you can make really bad decisions. You need to focus only on about 2 or 3 currency pairs in the beginning. There are so many things out there, so many currency pairs that could be overwhelming. It could be really exciting, but stick to it, just a couple, maybe even just one. Try the euro US dollar. It's the most liquid of all currencies. So understand how that works, become successful on that, then throw in the dollar yen. See how you go on that one, and kind of build yourself up on that. Coming over to the next one, don't add to losing positions. This is a big problem. People really, in the forex market, they cut their wins short and let their losing trades run. You want to be really doing the opposite. That doesn't make any sense to do that, because you get involved in the trade and you say it's going to turn and go up here, put your stop lower, then price going down. You're like, you have your ego involved too much, and you move your stop down and it still moves down. You say nope, it's still going to go up, and you keep adding on this position and you end up losing a massive amount of dollars. So do not do that. Don't overtrade. Don't be in 45 positions, and don't over leverage yourself and be short the euro US dollar, short the euro yen, short the euro odd, that sort of thing. You have 3 shorts in the euro, and you're risking 3 times what you should be, and if it goes against you, you just lost 3 times your trade. Don't try to pick the absolute tops and bottoms. That's where a saying comes into play, catching the falling knife. It's trying to predict where the currency pair will stop and catch at the very, very bottom. But whenever you try to catch a falling knife, you're pretty much guaranteed to get cut. So don't try to do that. Use your common sense, use your analysis. Always restrain your emotions, keep them in check. If you know you get angry whenever you lose a game, whether it be a monopoly or a trade, and you get angry and maybe throw a monopoly board somewhere, don't do that. If you know you do that, manage yourself when you're trading, because as soon as you lose, you don't want to get even or prove the euro US dollar that you're right and over trade it and get mad, and then you can really blow up your account. Remain humble and patient. Forex is all about probabilities. It's finding the most probable trades you can take, and it does take time finding maybe it reaching a certain resistance level or a support level before you can take it, but that's all about discipline. Keep yourself a trade log. You need to study your own success and failures, or else you won't know what you're doing wrong. Study the markets, learn some technical analysis and how the fundamentals can affect the market, and then try to go from there and put it into your personal strategy, who you are as a person. If you don't want to trade that much, learn only a certain amount of trades in a certain type of time, and then don't give up. It is really, you need a lot of patience. Just because you lose a couple trades doesn't mean you can just cross out the whole entire strategy. As long as you're managing yourself, managing emotions, and managing good money management, and the strategy should be working. It can't just be going against you a little bit now because the markets aren't doing what they want. There's no holy grail of strategies or trades. The losses, they are part of trading, and you need to realize that. So do not give up. And we'll go ahead and just touch on the requirements to start trading Forex. Very basic stuff here. Computer, internet connection, good broker, get some training, develop yourself a trading plan, get a little bit of a grasp on technical analysis. Say about 90% of the Forex market really trades on technical analysis. So if you understand that and you can see the same picture that everyone else does, you can help yourself out a lot. And of course, get some discipline. That's it. Hopefully we didn't go too far over time. We got to an hour, but that is the brief overview of it. If there's any questions, feel free to let me know or ask them right now. Easy for them to trend. Yes, when you could trade trend, that is a go-to. The trend is your friend to the end is a saying out there. You always want to trade a trend. If we're in an uptrend, you want to buy on the dips. When prices come down, prices do retrace quite often, so you can buy on those. And then if it's in a downtrend, you want to short on the rallies. So when prices go up, you want to sell at the very top. You can go counter trend. What makes it easy, Jim, I would say would just be if they go with the trend, you're going to be profitable for the most part. The ones that trade counter trend all the time are the ones that can end up losing because they're thinking they're trying to get the absolute top or the absolute bottom, and then their ego starts getting involved, and then it can start losing. So unless you start seeing things really start changing and you have good indication of the trend changing, that's when you really start trading counter trend. Naga, for my strategy, really what I do, I plot my trend lines in the mornings, and then I see where price is going, make sure I'm seeing different time frames, look at my monthlies and dailies and all that. Sure, I can touch on that a little bit here. I will pull up a quick chart here. Give me just 1 second. I'll give you a good example, hopefully. If I open up can everyone see my trade station here? Give me a yes or a no so I can make sure. All right, good deal. So we'll say we'll go to the euro US dollar here, and I'll show you how I utilize some of these. We'll take a euro US dollar here on a 240-minute chart. Okay, let me disable a couple things here. Get rid of this indicator. Okay, so basically part of my strategy, I'm looking over here first at the daily chart in the morning. I see where price is. I have a trend line here and here, and across these highs. Okay, so I'm in a rising wedge. I know this rising wedge here is a reversal pattern. So I know that means prices usually reverse once they get toward the top and pinch out and roll over. Then I use my support and resistance. I look for a swing high or a swing low. In this case right here, have a support, well, a resistance level rather, right here where prices hit and it really shot back down. Then I have a support down here across these two lows. You can see that's a nice little range. If we back out of here, so that's where we're kind of in right now. Then I use this one right here to kind of adjust accordingly as prices move throughout the day or the week. I'll adjust this. But the reason why I said this was support here is because right now price is above it. So once resistance is broken through, it comes support. And I see this right here, and I look at a couple things. Here's our MQ momentum. This is where you can start a trade counter trend here. This is where you can get in on good trades. Right here on the daily chart, mind you, this is a bearish divergence. And what a bearish divergence is we have momentum that's weakening. This shows the buying and selling speed or how fast it's rising here. So when we have higher prices, we want to see momentum get higher, right? But over here, price has gotten higher than this one. It's a higher high, but momentum is actually lower right here. So prices aren't converging. They are diverging. They're going away from each other. And we can see that it could start to roll over. We have a reversal pattern on a daily chart, and we have a bearish divergence. That's two indications that we might be changing direction here. But using this MQ indicator here, this is our MQ trend, and we have MQ regression right here. If these two are green, we're in an uptrend. If these two are red, like back here, we're in a downtrend. Okay, that's how we use one of those indicators. It's a filter. So right here, we're in an uptrend. But we have these two bearish signs that could indicate a reversal here. So we'll go ahead and look over at the 240-minute chart. All right, we see that we're in an uptrend here, green all the way up. This is where you could be really successful, Jim, where you can say it's easy. As long as you're with the trend, you're good. Buy down here, comes back down, buy, 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 that sort of thing. As long as you're with the trend, you should be fine. Right here, though, you see it's getting a little choppy. It broke through our MQ trend and our aggression are red, but then it came back up. This could be more of a consolidation period. We pull low right there, maybe pull level right down here, across these lows. You see where price is ranging now. And up here we have a candlestick reversal, if you understand candlesticks. We have right here is I'll pull up another indicator that we have. I'll enable it, value candles. You see that it's a red hat shooting star. That's usually an indication of a reversal. So we could take a short there, which I'm actually in a trade on that one, currently up on it as well. And we want to see this head down here, at least down to probably this area, maybe to this support. And this right here, we have a rising wedge on our 240 as well, which is a reversal pattern. So that's bearish and bearish. And this is kind of how we analyze the markets. We look at a bigger time frame, get the overall trend, look at smaller time frames, and try to find entry points. Look at the 60-minute chart. You see there's no upside momentum really, it's all downside. That's where we will take a short at on the 60-minute. That's against the trend again, so that's where you gotta be careful. You have to really understand the markets and make sure you're able to go counter trend. You see a signal on a longer term time frame maybe, and then you can see over here it's pretty well flat. And that's how I use the indicators really. The yellow hat shooting star was good as well because we are, the red hat shooting star, we're overvalued. So we're getting in really cheap on it. It's really overbought and we're bearish on it. So that could be the last hoorah of the market. So we could get in at the top, which is what we want to see. It really depends, Jim. It depends on the signals I see, and it depends on really your risk take. For this one, because I see it looks more bearish right here on the daily chart, I don't mind doing it for a swing trade because the price move from this high here at 13451 all the way down to my first profit target of, say, a retest this trend line here, 13256. That's like a 200 pip move, man. That's huge. If we're doing a $100,000 lot, you know, $10 a pip, looking at a pretty nice penny right there. But you have to be careful how you manage it. So I might take a trade. The trade I took today for this was on a 240-minute. I saw it overvalued, so I went ahead and went into it right up at the top up here. So there's no need for me to drill down because my profit target is going to be way down here. But if I'm looking at, say, a 60-minute chart, actually I think I have a good example here. If we look at, I think it was a pound, maybe. So for the Aussie dollar, here we could have traded counter trend as well. 60-minute chart, bearish divergence right in here. Nice, beautiful bearish divergence. We did go counter trend again, but you can see that top right there, which is also, it almost is a candlestick reversal, but you can see nice bearish divergence and prices really did shoot down. That's really the best time to go counter trend when you have signals like that that really do indicate that it's going to be reversing. So for this one, if I possibly missed it, or if I saw it starting to form, like I saw it right here starting to form, what I would have done is I would have looked at, say, a 30-minute, see if I can get in right in here. Okay, I could have. We had a nice overvalued spike. Then I might go to a 15-minute, look at it, same sort of thing, go back to over here where it was, see if I see a bearish divergence forming as well, or I see if I can find an overvalued price and try to get in there. So it really just depends on what I'm seeing on a different time frame. If I see prices starting to fall or start to move up a little bit on a larger time frame, I might look at a smaller time frame to see if I can get in an undervalued bounce to ride the longer term trend. So if we can go down to like even a 5 minute. Come back, I think the way over here. You can see we have a nicer picture right in here of what's going on. It's with the trend, and you could have taken a short right off there. But again, it's not a bearish divergence, it's just you see what's going on in the longer time frames, and I see that big signal on a 240-minute chart. I don't necessarily need to look at these smaller time frames because that longer term signal is going to beat out these shorter term signals, and these you have different profit targets as well. Anything else? If not, we'll go ahead and close it out here. All right. Well, if that's it, then no problem, Naga. Glad you got some good use out of it. Next webinar, we'll be talking about some trading plans and all that, how we can kind of personally evaluate ourselves to see what would be the best for us. We'll see, ask ourselves some questions and try to determine if we're going to be more of a swing trader or a day trader. Yeah, no problem, Jim. But yeah, that's it. Then we'll y'all have a good night. Hope y'all enjoyed it, and I look forward to seeing some of you in the trading room. Have a good one.